Hello, financial voyagers, and welcome to Investing Lighthouse. Are you prepared to embark on a voyage across the vast sea of investment and opportunity? Today, we're setting our course toward the shores of commercial real estate in the US. If you've been watching the news, you might have heard whispers of a looming storm in the commercial real estate market. So, is this storm on the horizon? Or is it just a light shower? Grab your financial compass because it's time to navigate this exciting terrain. Let's start by giving you a quick overview of what makes up the commercial real estate market. Picture this. You're standing at the foot of a towering skyscraper, watching hundreds of busy professionals scurry in and out of revolving doors. This is the office market, one of the significant components of commercial real estate. It encompasses anything from small office buildings to magnificent skyscrapers, housing every imaginable type of business. Now, imagine stepping off the busy city sidewalk and into a sprawling shopping mall. You pass storefronts of global brands, small specialty stores, and bustling food courts. This is the retail market segment of commercial real estate. It includes shopping centers, strip malls, and other spaces leased to retailers. But commercial real estate is not just about tall towers and shiny malls. Let's teleport to the city's outskirts, where warehouses and factories hum with the production rhythm. This is the industrial market, which includes everything from manufacturing plants to storage and distribution centers. Are you feeling tired yet? Well, let's take a break at a nearby hotel. Another crucial part of the commercial real estate landscape. The hospitality market includes hotels, motels, resorts, and even vacation properties. Finally, there's the multi-family market, which consists of apartment complexes and high-rise condominium buildings. Even though these are residences, they're considered commercial because they are owned to produce income. The commercial real estate market is a vibrant ecosystem, each segment with its own dynamics, yet interconnected. Imagine a coral reef, each type of coral, fish, and plant playing a unique role, yet all depend on each other for survival. Just like a coral reef, the health of the commercial real estate market is influenced by various factors like economic conditions, interest rates, and consumer behavior. Let's focus now on the office market, which accounts for approximately 25% of the US commercial real estate market. Picture this. The year is 2023, and vacancy rates in some regions of the US are as high as they've been since the Great Recession. Why? Two words: remote work. This work-from-home wave that started as a ripple during the pandemic has turned into a full-blown tsunami. With many companies opting for virtual offices, commercial landlords are seeing vacancy rates skyrocket. Why lease an expensive downtown office when your team can work comfortably from home? Right? It's like paying for a cruise ship when you only need a paddleboard. And while this shift might be good news for residential real estate, it's creating tremors in the commercial sector. But here's the twist, friends. This work-from-home trend is just the tip of the iceberg. Remember the banking crisis we navigated in our last episode? Well, it's also cast a long shadow over the commercial real estate market. With the rapid rise in interest rates to fight inflation and a tightening credit environment, the fear of a commercial real estate market meltdown is palpable. It's like a game of Jenga, where a single wrong move can bring the entire tower down. Let's take a deep dive into the scenarios that could cause landlords to face financial difficulties. Imagine you're a landlord and you own an office building. Many of your tenants, companies that had previously leased your space, have not renewed their leases due to the work-from-home trend. Suddenly, you're faced with sky-high vacancy rates, but you still have your mortgage, maintenance costs, property taxes, and insurance. That sounds like a rough ride, right? Now let's take it a step further. What if the bank you've borrowed from is a regional bank that wishes to reduce its exposure to commercial real estate loans? The tightening credit environment means they're less likely to renegotiate your loan terms or do so at a much higher interest rate. Couple this with already higher interest rates because of the Fed's fight against inflation and lower property values, and it only adds to your woes. It's like trying to sail through a storm with a leaky boat. But wait, is it all gloom and doom? Should we brace ourselves for the commercial real estate market to collapse? Falling property values may seem like a storm on the horizon, but does it spell disaster for the landlord? Well, not necessarily. The secret lies in the cash flow the property generates. Suppose you're a landlord with a building that's dropped in value, but you have tenants locked into long-term leases spanning 10 or even 20 years at rates agreed upon when the market was hot. As long as those tenants stick around, you can be cash flow neutral or positive despite the fall in property value. It's like sailing through a storm with a reliable compass. You can still navigate successfully. Secondly, commercial real estate isn't just about office spaces. There's industrial, retail, and multifamily housing too. And these sectors are showing resilience. For example, in 2023, Amazon leased a record-breaking 20 million square feet of properties dedicated to industrial purposes across the US to expand its delivery network. Finally, let's consider the appeal of mixed-use developments. These projects, combining retail, residential, and office spaces, are blooming nationwide. They're like all-inclusive resorts, offering everything you need in one location. Now let's delve into the intriguing case of Blackstone Real Estate Income Trust. For several months now, Blackstone has been limiting investor withdrawals. This might seem concerning at first glance, but let's zoom in. Remember, REITs invest in real estate assets, and real estate is not a liquid asset. Blackstone limiting withdrawals might be a way to ensure they have sufficient funds to ride out the current market turbulence. It's like tightening the hatches before the storm. It might seem extreme, but it's a precautionary measure. So, what's the takeaway, fellow navigators? The commercial real estate market is undoubtedly facing some significant challenges. But remember, with every challenge comes opportunity. A good sailor doesn't just steer through a storm, they learn from it. And as always, don't forget that the secret to staying on top in this exciting world of finance is to stay curious, stay vigilant, and keep diversifying your investments. But before we drop anchor on this episode, we'd love to hear your thoughts. Do you think the commercial real estate market is headed for rough waters? Leave us a comment below. And if you found this discussion insightful, show us some love by hitting that like button and subscribing to our channel. We'll continue exploring more fascinating topics in our upcoming episodes. Until next time, this is your Financial Compass. Signing off. Keep sailing, adventurers!